So you're a professional and you know you want to get into real estate investing, but you're torn. You're not sure which approach is best, passive or active. In this video, I'll describe to you what these two approaches are, their pluses and minuses, and clear up any misconceptions. And if you stay till the end, I'll share with you the approach that I've taken, and maybe that'll help you think about yours. I'm Dan, and I'm on a mission to help immigrant professionals grow their wealth through real estate. If you want a copy of my passive investing guide, please click down below in the description. When I first started my real estate investing journey, I thought about this question a lot, like what's the right approach for me? I've been both a passive and active investor now for some time, so I want to share what I've learned with the hopes that it helps you decide what path is right for you. First, let's talk about passive investing, and boy is this a hot topic. You'll see countless financial content creators talking about passive income ideas, lying on the beach, relaxing on a hammock, whatever it might be. Isn't that what it's all about? Well, no, not in my mind. Yes, a passive investor relies on active investors to make the most of their investment, but it doesn't mean lying on the beach, at least at first. You see, being a successful real estate investor really comes down to, and let me use an analogy here that comes from horse racing. It's about picking the right track, the right horse, and the right jockey. You need all three to be successful in real estate investing. First, let's talk about picking the right racetrack. Now, what do I mean by that? Well, what type of real estate do you want to invest in? That's what I mean by the right track. Now, you could be interested in apartments, short-term rentals, single-family homes, industrial, commercial real estate. There are many ways to get into real estate. Now, you may say, heck, I don't care. I just want to make the best return possible. I get it, but you do need to have some basic knowledge of the type of real estate you're getting into so you can make the best decisions with your money. And while all of these different types of real estate have their highs and lows, I'm a firm believer that most of them will work just fine. So you just need to pick one. What is the one that you want to get into? What is the right track? Maybe you're somebody that believes that housing is something that is so fundamental that you want to invest in apartments. Or maybe you're somebody that believes that the growth of this country through manufacturing and industrial work is the future, so you want to invest in warehouses. Really just think through, what do you want to focus on? Just pick one and dive in. So you need a jockey and you need a horse to win a race. So let's first talk about the horse. Think of the horse as being the investment property. So if you picked apartment investing, it would be a specific apartment complex that you're looking at. Sure, you want a property that maximizes your cash flow and your returns with as little risk as possible, just like you'd want the fastest, strongest horse that you can find. Now that horse obviously can't be in an area with high crime or with a future demographic outlook that isn't that great. So that's why it takes you getting familiar with that asset class and understanding, what's a good horse versus what's not a good horse. What's a great property versus what's not a great property. The other half of the equation is the jockey. And in my view, it's the most critical piece. Think of the jockey as the person or team that's actively managing that investment property. Just like a skilled jockey can get the most out of a strong and fast horse, a skilled active investor can make the most out of a certain investment. The right active investor can make a great property really pay off. Why do I think it's so important? Because a poor jockey can ruin the chances of even an excellent horse. That's why I believe that the active investor you partner with is so critical. So let's start with passive investing. How do you get involved in real estate passively? I see two primary ways to do this. The first, and probably the easiest, is just to buy shares in a REIT, which is a real estate investment trust. REITs are companies that own and operate income-producing real estate. These are often huge organizations that own a lot of properties in a certain asset class, say like apartments or industrial or cell phone towers, for example. And they own a lot of this real estate throughout the country and even the world. It's a good approach to get started, but it's not going to give you really great returns. The second way is to participate as a limited partner in a real estate syndication. A real estate syndication is simply a way that an active investor aggregates cash from a variety of passive investors, and they're known as limited partners, to purchase a specific property. That active investor leads the entire process from start to finish, and at the end, gives that passive investor the return they were looking for. Now, I happen to like real estate syndications because if you pick a great horse, a great property, pick a great jockey or an operator, you can get some great returns from this kind of a model. While these two approaches are passive, they do require some work, especially in the beginning. Notice that I said some work. So it's not no work. It does take some work because you have the responsibility to research the various options that are out there and identify the most promising ones based on what your goals are. This takes a little bit of work to get to know the real estate asset class you're getting into and to understand what's a good deal and what's not a good deal. But the work is worth it because it directly drives your returns. Now let's talk about active investing. These individuals take an active role in acquiring and managing a property. They're the ones that are doing the work to make sure that investment property pays off. What do? They come up with the idea, they put together a business case, they look for and analyze potential opportunities, they make offers and negotiate terms, they purchase the property, they lead in renovations if that's even needed, they make the property ready to rent out, they find residents, they manage the property so the residents are satisfied and they want to stay there, and they also eventually sell the property at the end at some point, if that's part of the plan. Now, if that sounds like a lot, it's because it is a lot. It takes a lot of work to be a successful real estate investor, so it's not for the faint of heart. It takes time, your own money, and a lot of work to be successful. And if you're a working professional, that can be daunting. I'm a working professional myself that's decided to take the active investing route, and it's a challenge to say the least, but it's doable if you really want to do it. Now let's compare active and passive investing to see which one might be the right fit for you. Let's first talk about the skill level that's needed to be a passive or an active investor. So in this case, you don't need a whole lot of skill to be a passive investor. Sure, you need to understand your asset class and how to identify good properties or good deals, but you don't necessarily need to have the skill that an active investor needs to have to really understand the whole process of investing from purchase all the way to sale. There's just a lot there. So you definitely need to have a lot more skill to be an active investor. Now, if you're interested in being an active investor but don't have the skill, that's okay. I mean, we all start from zero, right? But just know that being a successful active investor requires skill and investment to get there. Now let's talk about protection from risk. In this case, passive investors are often much more protected from risk than active investors. In REITs, they're completely protected. In real estate syndications, they're protected up to the limit, the amount of money they put into the syndication. Whereas an active investor probably has more exposure to risk. Now, there's certain things an active investor can do to help mitigate that risk, but it's something to be aware of. In terms of control, this is an area where the active investor really has the advantage because as an active investor, you get to decide what you do with that property, what to buy, when to sell, a lot of the investment decisions during the deal. That's really something that the active investor is going to be able to control the decision on. Whereas as a passive investor, you don't have very much control as to what happens with that property, which is probably a good thing because you want the active investor to be making the best decisions for the investment. In terms of time freedom, this is an area where the passive investor obviously wins. Sure, there's some work in the beginning to identify the properties and to get to know the asset class, but the active investor really invests a ton of time to make sure it works. So this is one where the passive investor obviously has a lot more time freedom. So when it comes to potential returns, this is where all that hard work pays off for the active investor because they do end up making more money and more income. But it doesn't mean that passive investors can't make great returns because they can. It's just that compared to the active investor, they probably do make less, but they still do have the ability to do well. And finally, let's talk about the tax advantages. Now, both passive investors and active investors get great tax advantages when it comes to investing in real estate. But active investors do have a little bit of a leg up because they have some more options available to them in terms of the tax benefits. But passive investors still get depreciation and still get a lot of those benefits that are just fundamental to real estate investing. So for both, there's a lot of tax advantages that they can both take advantage of. So in general, active real estate investing tends to work best for those that have a lot of capital, that have a long investment horizon, that have time to manage the properties, and they have the skill and expertise to do so. A passive strategy tends to be best for high-income earners like doctors, lawyers, architects, engineers, who have the funds to invest, but not the knowledge or the time or the network to find, purchase, and manage the properties that we're talking about. My own active investing path involved being a general partner in 3 different multifamily acquisitions, as well as launching my very first short-term rental. There are times when it's difficult to juggle both the W-2 and being an active real estate investor, because for me, I think this is the right path and the path that I want to take. Now, if you're wondering what a real estate syndication is, what a limited partner is, what a REIT is, I've created videos on all those topics. You can either click down below in the description or click on the video here at the end of this video. So what do you think about this? What's the right path for you? Let me know in the comments and I'd be happy to give you my own thoughts. Thank you for being part of the Immigrant Wealth channel, and I look forward to seeing you at the next video.